Let's Talk Accounting answers the question, what is? Removing the jargon of accounting, finance, and business. Shedding light on some of the jargon used, clarifying the jargon into everyday words you'll understand, and get a clearer view of what is happening in your world, building your confidence in the world of business. Let's get started. Number 13. What is contingent liability? It's a potential expense that may eventuate, but which should be provided for in properly kept accounts or budget. Potential lawsuits, product warranties, and pending investigation are some examples of contingent liability. Next. Number 14. What is credit risk? It's the danger a borrower will not repay a loan. Assessed by a credit analyst, normally reflected in the interest rate and conditions charged by the lender. Accurately judging the creditworthiness of potential borrowers is far more effective than chasing late payment after the fact. Next. Number 15. What is depreciation? The accounting practice which spreads the cost of fixed assets over their useful life. Depreciation represents how much of an asset's value has been used. The continuous, gradual and permanent decrease in the value of a fixed assets due to factors like wear and tear and time. Next. Number 16. What is discounted cash flow? It's the method of measuring the return on capital or funds invested. Taking into account the time value of money. Used to estimate the value of an investment based on the expected future cash flows. It is called discounted cash flow because in commercial thinking $100 in your pocket now is worth more than $100 in your pocket a year from now. Next. Number 17. What is disinflation? It's a fall in inflation, either through deliberate government intervention or a result of a development of an economic depression. Disinflation occurs when the increase in the consumer price level slows down from the previous period when prices were rising. During a period of disinflation, consumer prices are still rising, but at a slower rate, for example a drop in the annual inflation rate from 7% to 2%. Next. Number 18. What is deflation? Deflation is a general decline in the prices for goods and services. Because of a contraction in the supply of money and credit in the economy. The purchasing power of currency rises over time. In a deflation economy, get rid of old and new debt, dollars are worth more going forward. Next. Number 19. What is due diligence? It's an analysis carried out before buying a controlling interest in a company to determine that the conditions of the business conform with what has been said by the sellers. Creating a checklist, you can learn about a company's assets, liabilities, contracts, benefits, and potential problems. Next. Number 20. What is debt to equity ratio? It's a measure of a company's borrowing, calculated by dividing all financial debt by the shareholders' equity. It is a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. Next. Number 21. What is the economy of scale? It's the benefit of producing or buying in bulk as volume increases, the cost of an extra unit falls. At some point a business activity will reach optimum level of output and efficiency, after that the cost of producing additional units increases. Internal economies of scale can result from technical improvements, managerial efficiency, financial ability, or access to large networks. Next. Number 22. What is earnings per share? Earning per share is one of the gauges of a company's performance. It is calculated by dividing the company's earnings by the number of shares on issue, to show the profits earned in terms of each share. A higher earnings per share indicates greater value because investors will pay more for a company's shares if they think the company has higher profits relative to its share price. Next. Number 23. What is earnings before interest and tax? EBIT is the total earnings before provisions are deducted. This measures a company's performance, and it's often used in preference to net profit, as it excludes the effects of borrowings and tax benefits and adjustments. EBIT is a particularly useful metric when comparing companies with different capital structures and tax burdens. If you don't know what you're doing, it's a jungle out there. This completes the chapter. Watch this space for the next chapter of Let's Talk Accounting.